Coming up on Global Business, China announces that it will cut the reserve requirement ratio for banks by 25 basis points to keep liquidity reasonably ample and to better serve the real economy. Following adjustments to its COVID-19 measures, China moves once more to welcome people from around the world, with the latest move allowing foreign commercial performances to enter the country starting next Monday. And U.S. Treasury Secretary Janet Yellen testifies before Congress, saying that the American financial system is in good shape following the sudden collapse of two U.S. banks within days. Welcome, everyone, to Global Business here on CGTN. I'm Michael Wong in Beijing. First up, China's central bank is cutting the reserve requirement ratio, or the amount of money that banks must keep in reserve, by 25 basis points starting on March the 27th. Now, this is the first time this year that the People's Bank of China, or the PBOC, has cut the RRR, with the previous instance in early December of last year. Now, after the reduction, the weighted average RRR for Chinese financial institutions will stand at 7.6%. The central bank says the move will help ensure ample liquidity in the financial system and support the development of the real economy. The PBOC has reaffirmed its stance of implementing a prudent monetary policy and avoiding flood-like stimulus. It says it will better utilize monetary policy tools to support key sectors and weak points of the Chinese economy. And for more on China's latest RRR cut, I want to bring in Mr. Liu Zhiqin, Senior Fellow at Renmin University's Chongyang Institute for Financial Studies. Mr. Liu, thank you for joining us. So my first question to you is, we saw China's economy really performing quite well in the first 3 months of the year. We saw quite a substantial rebound in activity as well. So what prompted, you think, the PBOC to cut the RRR right now?
I think that this move is a very important signal to the global market. We see that at the moment, the economic recovery or economic development in China in January is very sound, very solid. But why we have cut this AAA? Because this is in line with the global financial turmoil, especially in the United States and the European financial market. As we know that some American bankers and European banks are under pressure to go corruption or other crisis. At this moment, we see that more challenges will be headed with all this economy in European countries and the United States. So when we are talking how to safeguard the liquidity of the banking system and the stability of our financial sections, I think to cut the AAA is one of the best tools that could be used to stabilize our market. As we know that in the past 3 days that the world monetary market and the capital market are in turmoil and in chaos, so make some uncertainty and nervous in the market. This is not good for further development. So PBOC has made such decision in the requirement of this market, also in line to safeguard the interests of our economy. Also, this action will help the world global financial market to be stable and healthy and sustainable.
Right. So just a reminder again for our viewers that RRR takes effect on March the 27th. And Mr. Liu, one of the top priorities for the government this year, for the Chinese government that is expanding domestic demand. Will the RRR cut help towards that goal? How significant is it? And do you anticipate any more rate RRR cuts this year?
I think whether we will further have more AAA cut this year, they will be decided by the market development, especially by the economic the development in the world, not only for China. Because as we know that long before we had adopted a policy that the dual circulation, that is the domestic circulation and also external circulation. The internal circulation mainly from the internal or domestic demand. When the outside demand is getting weaker or in uncertainty, so we have only the one chance of the way out is to strengthen or expand our domestic demand in order to make this more driving or more strengthened. So we have to make up some policies. AAA cut is one of the tools, and other also we have some more financial or commercial, even administrative measures to stimulate this goal. For instance, we should open up our market in a wide way. For instance, the market access must be minimized or even to be very realistic to give more chances for foreign investors. At the moment, we see a good news and a policy that many more foreign commercial visitors, partners, and even some new investors can come to China to have their own business. This is a very good signal. And secondly, also, we should open up all this market for foreign investors to have more investment in some special areas, special field, in order to get this situation boosted. So that's why China also need new driving force, new booster to promote our economic development. Financial, monetary policy is one thing. The other market open up is another important policy factor. We should follow it.
Well, I mean, China has been very consistent in that message as well. China has said that its doors will open wider and wider to the world. Mr. Liu, we're going to leave it there. Many thanks for your time as always. Mr. Liu Zhiqin, Senior Fellow of the Chongyang Institute for Financial Studies at Renmin University. Thank you. Well, China's cultural and tourism departments will resume the acceptance and approval of foreign commercial performances from March the 20th. It's the latest step in China's reopening after nearly 3 years of pandemic control measures. Authorities called on all regions and organizers to implement the country's epidemic prevention and control measures under the Class B protocols for infectious disease management. On the tourism front, China has resumed outbound group tours from March 15th to another 40 countries and regions, including France, Spain, and Brazil. This brings the total number of countries and regions allowed such group tours to 60. Meanwhile, far north Queensland in Australia is patiently awaiting the return of Chinese tourists. Now, before the pandemic, the region became one of the country's most successful international tourist destinations by heavily targeting visitors from the Chinese mainland. Greg Namaro explains.
In the late 1990s, restaurant owner Harry Su had an idea to open a business in Cairns, which was emerging as an international tourist destination. Su said the Chinese mainland was the key, where he made nearly 30 trips along with other tourism operators to build relationships.
We go to China and make friends with them and create big friendships. So the operators not just seeing Cairns as part of the Queensland or part of Australia. They see Cairns as part of their family.
Selling what the region had to offer wasn't difficult, from the Great Barrier Reef to pristine rainforests and the unique wildlife. One of those companies that saw the potential from China was the Capta Group, which operates 4 tourism-based businesses across the region.
As a region, Cairns and Great Barrier Reef, we're able to position ourselves as a must-do destination to see the Great Barrier Reef, but then also all the secondary experiences that come around the reef as well, and that's really, I guess, where we fitted in.
But for a time, direct access to the area was an issue.
Tourism officials say in the mid-2000s, this region was still largely overlooked by Chinese tourists. That's because they say people leaving from China to Australia literally flew over Cairns on their way to and from the capital cities.
And then we saw that rapidly increase. We've seen more than 5 different airlines run direct services from different parts, mostly southern China, coming directly into Cairns, and the numbers really lifted from there.
By 2019, 60% of international visitors here came from China, who were spending more and staying longer than tourists from other countries. That tourism pipeline was abruptly turned off at the start of the pandemic with the closure of international borders.
You've got more than 2,500 different products and experiences here in the region, and many of those businesses had staff either based in China or who had Chinese sales partnerships in place. So for many of us, the last couple of years have been really difficult.
Today, international tourists are slowly returning, only about 25% of pre-pandemic numbers. Harry Su says he's been forced to reinvent his business model, closing his most successful restaurants and opening this smaller venue. And he believes the key to reviving the area's connection to China is to start again from scratch.
That bridge we done and we built is collapsed. It's absolutely collapsed. So that particular bridge between here and there we built have to be rebuilt.
But that will again depend on the resumption of direct flights and establishing the kind of relationships that have served this region so well. Greg Navarro, CGTN, Cannes.
And still to come here on Global Business. U.S. Treasury Secretary Janet Yellen testifies before the U.S. Congress, saying that the American financial system is in good shape. That's, of course, following the sudden collapse of 2 U.S. banks within days.
.360-degree profiles of industry movers and shakers, tech mavericks, and policymakers. We drill down on their success. We ask how they set strategy and how they navigate in an increasingly competitive market. Real talk, real business. Join the conversation. Biz Talk, only on CGTN.
Well, after a strong start, European stocks couldn't hold on to their gains on Friday, with some shares seeing price fluctuations all throughout the day. Concerns about a banking crisis appear, though, to have lessened after several large U.S. banks joined hands to prop up First Republic Bank, that is the 14th largest U.S. bank by assets. The region-wide Stock 600, UK's FTSE 100 and Germany's DAX edged up by less than 1% in morning trade, but shed over 1% later in the day. Credit Suisse, of course, in the spotlight, the Swiss lender giving up early gains and falling by as much as 10%, indicating that investors remain skeptical about the bank's $54 billion borrowed lifeline. Shares of other European banks, including UBS, Deutsche Bank, and Societe Generale, rose in morning trade. For more on Europe's banks, let's head to Geneva, Switzerland, and check in with Julia Lyubova. Julia, thank you for joining us on the program. So first of all, what is the latest on Credit Suisse? Give us an update on that. And are there any fresh developments at the Swiss lender?
Well, certainly overnight, Credit Suisse saw a lifeline thrown to it by the Swiss National Bank. 50 billion Swiss francs liquidity facility was advanced to Credit Suisse. Well, this has bought some time for everybody to breathe and to take stocks. Well, Credit Suisse on its own part also said that it would purchase about $3 billion worth of its own debt to improve its financial ratios. And the decision by the Swiss National Bank divided political parties in Switzerland, who are now demanding transparency from the bank. Well, the bank itself is facing more troubles. Its US investors, they have hit the bank with legal action, claiming that it's overstated its prospects before this week's shares crash. And of course, those shares plunged as low as 30% earlier this week.
Yeah. Julia, overall, how have European banking stocks been performing today, and what has been the response from the EU and US financial sectors to the recent banking crisis?
Well, the European stocks on Friday, they have turned negative, and the European banking index has slipped 0.4%. Also the US stocks futures, they are also in the red. But the European Central Bank, they held an unscheduled meeting of its supervisory board this morning to discuss the latest sell-off of bank shares. And well, they've had 2 impromptu meetings because of the recent market turmoil. It is not expected for the European Central Bank to make any immediate action, but of course the situation is certainly closely watched.
Yes, and we will certainly be keeping a close eye on Credit Suisse. Many thanks for that report and update, Julia Lyubova from Geneva, Switzerland. Excuse me. Thank you. Well, moments ago, Silicon Valley Bank Financial Group has filed for bankruptcy protection. The move is aimed at keeping the bank's 2 other valuable assets, SVB Capital and SVB Securities, ready for buyers. This came after U.S. Treasury Secretary Janet Yellen sent out the message that the American financial system is in good shape. Ms. Yellen testified on Capitol Hill on Thursday in order to calm nerves and reassure lawmakers. In the meantime, as we were reporting, several large U.S. banks injecting some $30 billion in deposits into First Republic Bank on Thursday to rescue the lender. CGTN's John Terrett has more from New York.
Treasury Secretary Janet Yellen was always slated to address the Senate Finance Committee on Thursday, but she was supposed to do it talking about the Biden budget that was released a week earlier. In the end, of course, the banking crisis took over and she spent most of her time testifying about that. Her main message, the U.S. banking system is sound, U.S. deposits are safe, and no U.S. taxpayer cash is at risk in helping the depositors.
Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
Of course, Janet Yellen was speaking a day after Credit Suisse, the much troubled but still very large Swiss bank, had its shares suspended for a while in Europe, and on Wednesday it closed down 14% after one of the major investors in the bank, the Saudi government, said it would provide no more money in the event of problems at Credit Suisse going forward. Well, overnight there was a deal done between Credit Suisse and the Swiss regulators. A loan of $54 billion is now on the table, and the market seemed to like that. They were reassured. Credit Suisse shares in New York were up by 7%, then later 2.5%, and then they closed down pretty much flat. The Dow was ahead by 370 points. There was a tech rally on the Thursday session. However, there's still a sense that the shoe has yet to drop in the banking crisis, and a rescue coalition of banks has been put together. Big names like JP Morgan Chase, Citi, PNC, and Bank of New York. They will deposit $30 billion into the coffers of a regional bank called First Republic, which Moody's, the rating agency, says is one of 6 banks here that are vulnerable to possible collapse. However, the big issue on Wall Street remains inflation. The central bank, the Federal Reserve, will meet next Wednesday. It's at the moment slated to increase interest rates by 25 basis points. Wall Street thinks it's possible there will be no interest rate hike at all to combat inflation. And if that happens, that will be an indication of just how serious the central bank, the Federal Reserve, takes the potential banking crisis. It is, in other words, all eyes on the Fed until next Wednesday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
And U.S. President Joe Biden has also insisted that the U.S. banking system is safe. President Biden also pledging to take measures to avoid further losses. Here's what he had to say on Monday.
I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this: Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed.
Meanwhile, some major economies continue to trim their U.S. Treasury bond holdings at the beginning of the year. That's as Federal Reserve maintains a hawkish stance, a move that will slash its returns on overseas investments. According to Treasury International Capital data released by the U.S. Department of Treasury, total foreign investors' holdings in January dropped some 3.3% from the same period last year. Belgium cut its holdings the most by $23.2 billion, followed by other creditors including China, Luxembourg, Germany, and France. In the meantime, Saudi Arabia also saw its U.S. securities holdings drop to the lowest level in the past 6 years. That's after a $9 billion slash. For more on the banking turmoil in the United States and Europe, let's bring in Alexandre Kadeb, economist, policy advisor, investment strategist, founder and chairman of the Multipolarity Report, which, among many of its services, provides macro analysis, market strategy, and business intelligence. Alexandre joins us from Paris. Alexandre, welcome.
Thank you for having me on the show.
So, first of all, Alexandre, in light of the market jitters in the U.S. and European banking systems, what's your take first on the ECB's decision yesterday to still press ahead with the 50 basis point rate hike? I mean, how do you see this move impacting sentiment for European corporates and European banks?
Yes, thank you, Michael. I think the move was expected because, if anything, the ECB and Christine Lagarde wanted to display a show of confidence in the strength of the European banking system, and it had also to proceed with its fight against inflation. So the logical decision was to keep raising rates while also acknowledging the concerns about financial stability and keeping ready any tools available to address any such issues should they appear. But I think Lagarde was right stating that the European banking system, especially in the Eurozone, was much stronger today than it is or than it was, for example, in the aftermath of the global financial crisis in 2008.
Yeah. Well, a lot of focus on Credit Suisse, understandably, Alexandre, because Credit Suisse is a global systemically important bank. At least as of 2021, total consolidated assets of Credit Suisse was around 104% of the entire Swiss GDP. But we also know in recent years, Credit Suisse has suffered major reputational damages and is currently going through a big restructuring. Is that 50 billion Swiss franc, 54 billion US dollar lifeline to Credit Suisse, is that going to be enough to allay market worries about the bank's long-term health?
Well, frankly, I don't think so. I think this 50 billion were needed to buy some time in order to proceed with the restructuring of the bank and to manage this crisis that we are going through now, also that comes from the US, which reinforces this negative feedback loop for Credit Suisse, which has been in the investors' radar for many months and which has seen its deposits base being halved from last year to this year. So Credit Suisse trouble actually was brewing for a long time, but now it's a kind of belated recognition, and investors are starting to pull their money out and actually started, especially in Asia, to pull their money from the bank's wealth management division. And this is where really the problem is, because if there is something that should remain at Credit Suisse, it's the wealth management division. While the investment banking, they actually wanted to spin it off and resell it back to some US investors, the first Boston Credit Suisse, returning back to its US roots. And I think this was the thing to do. But the management is actually caught up in this crisis. It has not seen coming. And now it has to go through this crisis. But there will be other decisions that could come further down the road. Yeah. Will it be the Swiss government taking a share, or will it be a merger with UBS? We will see what happens.
I mean, I find it amazing, Alexandre, that we saw customer deposits at Credit Suisse dropping by some 100 billion Swiss francs from 2022 compared to 2021. We have to remember Credit Suisse saying it has a material weakness in its reporting, so have to keep a close eye on that. Big picture, though, right. When we talk about trade-offs and balancing acts, the U.S. Federal Reserve and the European Central Bank are in quite an unenviable position of trying to balance inflation, trying to maintain financial stability, and not overly wrecking their respective economies. How difficult are these trade-offs, and will the Fed pause or slow next Wednesday? And if the Fed does pause or slow, doesn't that send a signal that things are pretty bad or worse than expected?
Well, I think, as you mentioned, these trade-offs are extremely difficult to handle. But there is a silver lining in this crisis, so to say, because if there is a banking crisis and banks continue to tighten their lending standards, then we will see a credit crunch that will actually hasten the recession that everybody was seeing for the US and for Europe to come later on this year, except the politicians in the US and in Europe, which were sticking to that Goldilocks scenario. If you remember Treasury Secretary Janet Yellen saying a few weeks or a few days ago that she still believed the US economy won't go through a recession. So actually, the trade-off is not as difficult if you consider that recession is down the road, and with recession, inflation should drop also drastically. But you need to address a message of confidence to the economy and to the markets. And therefore, I think the Fed should proceed with even a minor interest rate hike next week, maybe 25 basis points, to show that it can disentangle these two issues between financial stability issues that have to be managed and that are currently being managed on one side, and the macroeconomic and macro policy mandate related to inflation, which also has to be managed. It's a very tricky, decision making, but there is a lot of communication to do in order to gain trust and confidence. It's all about trust and confidence after all.
Yeah, absolutely. I mean, you bring up a good point. The banking turmoil, if that leads to a squeeze in credit, I guess that would be equivalent to rate hikes from both the ECB and the Federal Reserve. Alexandre,
Exactly.
have we entered an environment where we need to perhaps brace ourselves for more volatility in the global banking system? We were talking about First Republic Bank seeing some trouble on Thursday as well, Credit Suisse, and of course Signature and Silicon Valley Bank. An environment where more things could potentially break because we went from an ultra low interest rate environment to a high interest rate environment, and potentially may have to stay at this high interest rate environment for longer at quite a rapid pace.
Yes, absolutely, Michael. I think this is what is happening right now, following this decade actually of ultra low interest rates, and the world and markets got used to that environment of cheap liquidity, and actually now we are getting out at speed from that previous macro regime into another macro regime that is much more, reminding of the 1970s era of macro and financial dislocations. What that means is that the level of risk in the system, the level of volatility will increase and is increasing significantly, and any policy mistakes will be, immediately sanctioned by the markets. And this is the difficult environment if we compare it with the 1970s, where actually markets were much smaller than they are now. Now you have these derivative contracts in the interest rates, in the foreign exchange markets, for example, that are several times the GDP of the global economy. So any development is very quickly, translated into a sell-off and increasing levels of volatility. And now, if you add the new technological innovations with the rise of digital banking and with crypto currencies, now this speed and volatility is increased by this new developments, actually, as we have seen with the smartphone bank run, so to say, in the case of Silicon Valley Bank.
Absolutely. Okay, we're going to leave it there. Fantastic insights. Thank you so much, Alexandre Kadeb, founder and chairman of the Multipolarity Report. Thank you. And with that, we're going to wrap up this edition of Global Business here on CGTN. I'm Michael Wong here in Beijing. We'll see you again next time.